All right, let's get right into it. Today, we're brewing up a classic head-to-head investment analysis. In one corner, you've got Farmer Brothers, that's ticker FARM, and in the other, Coffee Holding Company, ticker JVA. Now, they're both in the same business, wholesale coffee, but believe me, their stories and more importantly, their numbers could not be more different. So the big question is, which one, if either of them, is actually the better investment? Let's break it down.
So, right off the bat, you can see a huge difference in size. Farmer Brothers is more than 3 times bigger when you look at revenue. And they focus on those big clients, restaurants, hotels, that kind of thing. Coffee Holding Company, they're the smaller player, and they've carved out a totally different niche, focusing on private label brands and specialty stores. So we've got two very different strategies in the exact same game.
Here's how we're going to tackle this. We're going to go through 6 rounds, kind of like a boxing match. First, we'll set the scene with the industry itself. Then, we'll dig into their business models. After that, it's a deep dive into the financials. We'll ask if either has a real competitive edge, figure out what they might be worth, and then finally deliver the analyst's verdict based on our source material.
Okay, let's kick things off with the playing field. And you really need to get this from the start. This is a seriously tough market for both of these companies to operate in.
You know, it's kind of funny. We all drink a ton of coffee, right? So you'd think demand would make this an easy business. But it's not. For wholesalers, turning that demand into actual profit is a constant fight. They are just squeezed from all sides by fierce competition, margins that are paper thin, and of course, the ever-changing price of coffee beans. It's just a really, really difficult place to thrive. So knowing that the industry is such a struggle, how does each of these companies actually try to make a buck? Let's look at the daily grind of their business models. On the surface, they're both pretty simple B2B operations, but the details are what matter. Farmer Brothers is at direct supplier, but the source analysis points out it's kind of stuck in the middle. It just doesn't have the size to compete with the giants. Coffee Holding, though, acts more like a middleman, an intermediary, really, focusing on those niche clients. For them, it's all about being nimble and efficient. All right, here we go. This is the main event, the financials. This is where we pop the hood and really see which company is in better shape. We're going to look at their profits, their debt, and, crucially, their ability to generate cold, hard cash. And wow, this table right here, this is where the story really starts to diverge. Look at the net margins. JVA's is razor thin, less than 2%, which is tough. But Farm's, it's actually negative. But here's the number that really, really matters for an investor: return on equity. You can see JVA is pulling in a modest but positive return for its shareholders. Farmer Brothers, on the other hand, well, it's a completely different situation. Let's just sit with this number for a second. A negative 48% return on equity, that is just staggering. What it means is that for every single dollar of shareholder money in that business, the company is basically lighting almost 50 cents of it on fire. That is a massive, massive red flag. Now, compare that to JVA's nearly 7%. Look, it's not going to make you rich overnight, but it's positive. It shows the business is actually making a profit with the capital it has, not just burning through it. The difference between these two numbers is just night and day. And the story just keeps going when you look at their balance sheets. Farm is carrying almost $56 million in debt. That's more than double what the entire company is worth on the stock market. JVA, meanwhile, has less than $5 million. And check out that current ratio. JVA's is strong, over 3, meaning it can easily pay its bills. Farm's is a lot tighter, which is not what you want to see. Okay, so one of the few bright spots for Farmer Brothers, according to the analysis, is its cash flow. So despite losing money on paper, it is actually bringing in positive free cash. JVA does too, but for both of them, these numbers are pretty small. It just doesn't give them a lot of firepower to pay down debt or reinvest in growing the business. So, with all that financial info in our heads, let's ask the next big question. Can either of these companies actually defend their business from competitors? Do they have any kind of competitive advantage, what investors call a moat? Well, the verdict from the analysis is pretty blunt. Neither one has a strong moat. Farmer Brothers is basically stuck selling a commodity. Its customers can switch suppliers tomorrow with almost no hassle, and it's just too small to compete on price with the big players. JVA's edge is really just its relationships, and that's a pretty fragile advantage that can disappear over time. Okay, so this brings us to what might be the most important question of all: the price. We know these businesses have some serious problems, but is the market giving one of them away for cheap? Let's check the valuation.
And here it is, the moment of truth. Farmer Brothers, with a stock price around $1.26, is trading almost exactly at its estimated intrinsic value. There's basically no discount, no margin of safety. But Coffee Holding Company? That's a different story. It's trading around $4.64, but its intrinsic value is estimated to be over $6. That gives you a potential margin of safety of around 25%. So, after going through all of that, what's the bottom line? Let's bring the analysis from our source material to a final conclusion. But first, let's just quickly recap the big risks here. For Farm, it's pretty clear. Way too much debt, terrible profitability, and it's just too small to compete effectively. For JVA, the risks are more about the tough industry they're in. You know, those thin margins, the price of coffee beans, and constant competitive pressure. The final verdict on Farmer Brothers is, well, it's pretty harsh. The source material calls it a potential value trap. That's a stock that looks cheap, but it's cheap for some very good reasons. The recommendation? Avoid it. Unless the price totally collapses, it's just too risky. For Coffee Holding Company, the verdict is a lot more nuanced. The analysis admits it's a low-quality business, but it's profitable, it has a clean balance sheet, and it's trading at a discount. So the final call is a hold, or maybe even a cautious buy, but only if you can get it at the right price. And all of this leaves us with one last, really important question to think about. This whole comparison comes down to a classic dilemma for investors, right? You've got a financially weak company at a fair price versus a slightly better but still mediocre company at a discounted price. It really makes you ask, in a really tough industry like this one, is paying a good price ever really enough to make up for buying a low-quality business? That's definitely something to chew on. Thanks for watching this breakdown.